You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to the Investor Way with me, Sam Ball. It's the 24th of December 2024, and I'm joined by my co-host John McEwen. In this week's episode, we'll be discussing Bunzl, Baltic Classifieds Group, Carnival, Supreme, Hollywood Bowl, and our US company of the week is Ashtead. John, do you want to start us off with Bunzl?
Yes, so we have covered it before on the show, but for anybody who doesn't know, it's the UK's leading supplier of disposable paper and plastic packaging supplies to an array of businesses and industries, including supermarkets, food processors, non-food retailers, and convenience stores. And I say it's UK listed, but it has most of the revenue coming from abroad, including North America. Anyway, on with the trading statement. So the group is expecting full year revenue to be around 3% higher than last year, ignoring currency impacts. Growth is being driven by acquisitions, with underlying revenue expected to see a small decline for this year. Volume growth in the third quarter is expected to continue into the fourth, but deflation is likely to be more persistent than previously anticipated, impacting profits for the year. Despite that, the underlying operating profit is expected to show a strong increase on the prior year. Over the year, Bunzl has committed £850 million worth of acquisitions. £200 million of the £250 million share buyback has been completed, and the company has confirmed its commitment to start a new £200 million share buyback next year. For 2025, revenue growth is expected to be driven by acquisitions with some underlying revenue growth, and the shares were down around 5% in early trading. In terms of valuation, the group has a market cap of just under £11 billion and trades at 17 times forward earnings with a 10-year average of around 18, and it has a prospective dividend yield of 2.2%. I think neither of us have been particularly keen on Bunzl. It's a market that is fragmented, and the group have historically taken advantage of that. They have delivered fairly strong and consistent growth over that time. It's been an acquisitive strategy which has essentially accounted for about 2/3 of the impressive 9% compounded annualized growth in revenue over those years. It's a strategy that is clearly delivering for them. Trading statement perhaps a little bit disappointing. I don't think it's particularly a market I'd like to be involved in. And you do wonder how long that strategy can continue to work for the group. However, historically, it certainly has. Wouldn't be betting against it, but I think there are better companies out there. And it's certainly not cheap at 17 times forward earnings. Sam, what are your thoughts on Bunzl?
Pretty similar. I think that 9% compounded growth rate, as you've said, is pretty good, especially if you look at how the FTSE as a whole has performed. So I don't think you can really knock the performance. But I don't love the industry, as we mentioned last time. It's not an industry I'd want to get into. And it's a bit, I view it a bit like Halfords, where yes, it's fragmented, but I don't necessarily agree with that being a huge opportunity. Whereas if you were to take another business, Dunelm, which is also in a fragmented industry, I think with Dunelm, it kind of makes more sense that there's more chance for consolidation. I don't see it as much with distribution because it's just so easy for any guy with a van to pop up and start distributing. So I don't think you get as much of the benefits of economies of scale with it. And as well as that, what I don't particularly like is just that the revenue is actually dropping on an underlying basis. So the growth is only coming from
Yeah.
acquisitions, which is obviously working fine for them, but it's just not the type of business that I'm interested in because they have to keep getting the acquisitions right for you to keep getting the returns. So if it's a tough market or business, valuations are particularly high, you're probably going to see a period where those earnings are just going to decrease because they can't do the acquisitions to make up for the revenue they're losing. And then when you've paid 17 times earnings for it as well, I think you can do a lot better for 17 times earnings.
Okay. I imagine that Baltic Classifieds trades for more than 17 times earnings. How are they doing?
Unfortunately, yes, it does. So they are doing very well. So it is a business we've covered before, but for anyone who's not familiar, they're the leading online classifieds group in the Baltics. So I think they're basically the Craigslist Auto Trader, Rightmove, and Indeed of the Baltics. And they're listed on the FTSE. And they've come out with their half-year results for the 6 months to 31 October 2024. Revenue was up by 17% to 41.8 million euros, and all these figures will be in euros. Core classifieds revenue, streams business to consumer and consumer to consumer, which together constitute 90% of total revenues, both grew by 17%. EBITDA grew 18% to 32.9 million, with the EBITDA margin expanding 1 percentage point to 79%. Adjusted operating profit was 32.5 million, and that's tracking closely to the EBITDA. Operating profit grew 36% to 26.4 million. Adjusted basic earnings per share grew 24% to 5.7 cents, while basic earnings per share for the period grew to 4.5 cents. Adjusted net income grew 21% to 27.6 million, with the only adjustment to profitability being the amortization of acquired intangibles net of the corresponding tax impact. Profit for the period grew 41% to 21.7 million. Cash generated from operating activities grew by 17% to 34.2 million, with a cash conversion rate maintained at 99%. 13.5 million was returned to shareholders through the ongoing share buyback program, and that compares to 7 million in the first half last year. However, that's on a market cap of 1.5 billion pounds now, so not really making a dent. They've voluntarily repaid 5 million of debt during the period, and 7 million more was repaid after the first half ended during November. Net debt at the end of the period was 25.6 million, and they ended the half with leverage at 0.4x, and that's down from 0.5x a year ago. An interim dividend of 1.2 cent per share was declared, up 20%. And the revenue per segment was up 17% for auto, 26% for real estate, 17% for jobs and services, and 4% for generalist. And in terms of the revenue mix, of 41.8 million revenue, 16 million comes from auto, 11 from real estate, 8.2 from jobs and services, and then just 6.6 from generalist. They maintain their significant leadership position over the nearest competitor for all of their largest sites compared to 2024. Autoplius.lt is at 7x the nearest competitor, Auto24.ee at 40x, Arudus is at 24x, KV.ee plus City24.ee in Estonia are at 15x, CV Bankus is at 5x, and Skelbiu is at 19x. The number of monthly listed ads increased by 1% in auto and 2% in real estate, and listed ads on the generalist platform declined by 6%. Traffic to the website averaged 55.8 million visits per month, which implies the entire Baltic population visited their sites 9 times every month. And in terms of the valuation, the business trades at a forward PE of about 37. The market cap's £1.5 billion. And if you were to just go on free cash flow instead of earnings, you would still get a free cash flow of 34. I'm going to say the same thing I say every time. It's a fantastic business. I love it. I mean, if you get in the UK, if you get Rightmove, Auto Trader, and say something like Craigslist and Indeed all in one business, that would just be fantastic rather than having to invest in them individually. So I love the group of businesses they've got. It's a group of businesses that you'd think have significant long-term tailwinds. Fantastic business, fantastic results. They seem to be doing everything right in terms of the management. There's not really anything I can criticize, especially when you look at how dominant they are in their markets. But if this grows 17% a year, the earnings are probably going to go up by more than that because so much of it is going to, you'd think the cost base isn't going to change significantly now. So a lot of it's going to flow through to earnings. But even still, if we're generous and use free cash flow instead of earnings at 34x, it's unbelievably expensive. I just wouldn't be comfortable paying it because there's a lot of space for it to go down if the results stop being as good, which they could well do. So it seems like they're pretty saturated and I don't see much opportunity outside. And this seems to me like a Rightmove kind of business where it's like they might be able to increase revenue like clockwork by 10% a year, but they're not going to be popping up in France anytime soon and opening up new markets. I just don't really see it. But I could be wrong with it, but I would buy it on the basis they're not going to be expanding outside of the Baltics. And when it seems like they're pretty saturated, if the whole population's already using it 5 times a month or whatever it was, 9 times a month, sorry, I think at 34 times free cash flow, I just think it's too expensive. So it's one I will be keeping an eye on. It is on my watch list and I would love to own it, but it would have to come down a lot before I took a serious look at it. What about you, John?
Yeah, very similar. I think it's a fantastic business. It's essentially got near monopoly status in the markets that it does operate in, but the price it is so expensive. And as you say, where does the further growth come from? Given the current valuation, and if that slows it all, you'd expect a big fall in the share price. So sadly, it's probably not one for me.
Shall we move on to a cheaper business?
Yes, so a much cheaper business. Carnival, we have covered it before. It's the cruise liner and it's got brands, well, 9 brands amongst its portfolio, including Princess, P&O, Cunard, with the Queen Mary 2 amongst the fleet. Anyway, they had their fourth quarter results out with fourth quarter revenues up by 10% to $5.9 billion on last year due to increased ticket prices and onboard spending. Underlying cash profit EBITDA grew by 29% to $1.2 billion, exceeding guidance by $80 million. And this reflected both the uplift in revenue and tight cost controls. Underlying free cash flow rose from $240 million to $366 million, benefiting from lower expenditure on investment. And net debt was down by $1.9 billion to $26.3 billion. Booking volumes in the fourth quarter increased despite a reduction in capacity. And in 2025, Carnival expects an uplift of around 8% in underlying cash profit to $6.6 billion. And the shares were up around 3.5% in early trading. In terms of valuation, Carnival has a market cap of £24 billion and trades at 1.1 times forward sales, compared with a 10-year average of 1.34, and they currently don't pay a dividend. It's a very, very difficult industry, as we've said many times before. I think Carnival probably is the best player in that industry. It does have the strongest brands and it's benefiting currently from strong demand. Potentially because it does have that older client base, maybe that they're a little bit less sensitive macroeconomically, but it's a tough old industry. And since COVID, they have had their debt piled on. It's currently around 4.3 times underlying cash profits EBITDA. They are clearly paying it down, but I think this type of industry, given how capital intensive it is, certainly when they're developing and building the cruise liners, I think there are far, far better businesses out there. And it's just a sector overall that I just completely unattracted to. Good to see, I think, for their sake, though, that there is progress that's going on. And I certainly don't think you can knock these results. Sam, what are your thoughts on Carnival and and the fourth quarter results here?
Very similar. I think they've done quite well actually since the pandemic in terms of I think we've covered them in the past and just said they're totally uninvestable because of the debt pile. I would now say they're no longer uninvestable because of the debt pile. It's just the industry probably. I think the debt's coming down and I think it's also been it's 4.3x underlying cash profits, which is not ideal and it's definitely at the higher end of what you'd want. But it's also not in a position anymore where I think once it gets to sort of over 5x, it's like, well, how are they ever going to pay that back? And if something goes wrong whilst they are paying it back, they're just stuffed. So I think they are at a point where it is now starting to look manageable. But then you go and look at the EBITDA, which for the quarter was 1.2 billion, but the free cash flow was only 366 million. And I think a lot of that is money that's flowing out on the debt repayments. So as a shareholder, the amount of time you still have to wait before you start getting returns. And even then, I think unless you've bought it at the lows of the pandemic, how good are those returns actually going to be if you're buying it now in a much healthier position? So I wouldn't be interested anyway because of the industry, but I think if you actually were interested in it, I think the time to buy it was probably 3 years ago. Because for the risk you've still got, I'll just have a look at the share price. Yeah, because the risk you still got, I'm not sure you're being as compensated as well as you would have been if you'd bought it at the COVID lows. Well, I guess it's still actually, if you look at it over 5 years, it's trading at over £30 a share pre-COVID, and it's still only at 18, 19. It was like in 2016, it was trading at over £50 a share, but
Gosh.
I struggle to see it getting back to that for a long time because they've still got a lot of debt to chip away at. You're not going to be getting, I don't think, any decent dividends in the near future because they have to pay off the debt. And I think this is probably the kind of business that historically would have been bought for the income as well,
Yeah.
which there no longer is. So you'd have to have a very, very long-term view still if you're buying it. And I'm just not sure if it's worth it, given how long it would take, and there's still significant risks involved. So yeah, for me, I just wouldn't be interested anyway because of the industry. But it's good to see the business is doing better than I probably would have expected, actually.
Okay. On to a consumer goods company and one that's recently entered the tea market.
Yes, so Supreme, which I am a shareholder of, so we've covered them multiple times before. We have tended to focus on the vaping side of the business, which is where most of the growth is coming from and where over 50% of the revenues come from. However, yeah, so on 28th of November 2024, Supreme announced the acquisition of the trade and selected assets of Typhoo Tea Limited, a long-established and well-known British tea brand, for a total cash consideration of 10.2 million out of administration. The deal includes Typhoo Tea's stock and trade debtors, which has a book value of 7.5 million, and Supreme expects the integration of the business to proceed without disruption to existing operations or customer service levels. Established in 1903, Typhoo Tea was the first pre-packaged tea brand in the UK and has since expanded its product offering from traditional black and decaffeinated black teas to now include white and lemon instant flavors, herbal and fruit tea infusions, and a selection of coffees across a portfolio of brands, including the iconic Typhoo brand, but also QT, Lift, and Heath and Heather. Typhoo Tea supplies all the major UK supermarkets and discounters, as well as health food store Holland and Barrett. Typhoo Tea also distributes products into both the Ministry of Defence and the NHS, alongside servicing international consumers across North America, Europe, Middle East, and Africa and Southeast Asia. For the year ended 30 September 24, Typhoo Tea generated unaudited revenue of approximately 20 million and a loss before tax of 4.6 million. Under Supreme's ownership, it's anticipated that Typhoo Tea will operate on a capital-light, outsourced manufacturing model, which the board believes can generate a gross profit margin of around 30%, with a much reduced overhead base. As with previous transactions, Supreme expects the acquisition to be adjusted earnings enhancing. In the strategic rationale, they've said the acquisition will further accelerate Supreme's broader diversification strategy, bringing non-vape annualized sales to over 120 million, approximately 50% of revenue. Typhoo Tea is a well-established UK consumer staple with 73% brand awareness and a high-quality customer list. Typhoo Tea's established asset-light outsource model will be further enhanced by Supreme's existing vertically integrated distribution platform, which already services a number of existing customers. The combination of Typhoo Tea's product set alongside Supreme soft drinks and sport nutrition and wellness categories will enable the group to further develop sales, marketing, and product innovation opportunities, including additional sales across Supreme's established customer footprint of supermarkets, discounters, wholesalers, and online retailers, and development of additional own-label products or licenses under well-recognized brands, replicating Supreme's long-standing success in the batteries and lighting categories. The acquisition will immediately broaden Supreme's UK retail network, add in more high street names, including Holland and Barrett, which could generate sales opportunities across multiple segment categories and products areas. So I was a bit miffed by this at first as a shareholder. However, upon looking in the detail, I think it makes sense. I think it's a good brand. I don't think there's a huge amount of risk if they're paying 10.2 million and they're getting stock and debtors worth 7.5 million, assuming those debtors are fully collectible. So they're only really paying a few million quid for this, for what is a very good brand. They're planning to just outsource it. They've done a very good job with the lighting and the batteries, which they've referred to. And I know it's not quite the same business, but we have seen it on the vaping side already, where they've bought some vaping brands and basically kind of brought the distribution or whatever to their Manchester facilities, managed to slash down the overheads because they've already got so much spare capacity in terms of their own distribution. And it has instantly contributed to the earnings. So I don't have any reason not to believe that. I also think the points they're making about, it gets them into with different suppliers such as Holland and Barrett, so they potentially have the opportunity to sell other products to them as a result of the connections they're going to be inheriting. But it also gives them the chance to get Typhoo Tea into anywhere it's not currently that they deal with. And I think really it's just kind of it's making the whole network of connections stronger, really. So I think it's a smart acquisition. And if it doesn't work, I'm not going to be sat here in 6 to 12 months saying that this was just a stupid thing to do. What they do in buying tea, I think it sits well, nicely within the drink side of the business that they've already got. And I think with the kind of businesses they are servicing and supplying, I think if anyone's going to make a success of this, it's going to be Supreme. If we were to just buy it on our own, I think we would struggle to probably produce the kind of numbers that Supreme are going to start producing from this business because of the foundations they've already got that they can just build it on top of. So I'm very happy with it. In terms of the valuation, Supreme's currently trading at a PE of 8. I think it's probably quite discounted because of the upcoming vaping ban in 2026. And this also helps them diversify away from vaping, which is quite good as well. So, John, as someone who's a bit less biased, what do you think of the acquisition?
I think it's very sensible. I think I get why you would be reluctant at first with it, but I think Supreme can make it work. And on paper, at least, it doesn't look like they've paid very much for it and they're not taking very much risk. But I think it fits well within their portfolio. It does diversify away from vaping, which we don't know how it's going to go with the ban. Well, I say the ban, the new regulations for Supreme. It may not be as bad as I know you've got that discounted share price reflecting it. It could be tricky and hit their earnings. But I think Taifu is a strong brand. I know it was run by sort of private equity before and kind of run into the ground. But with the distribution they have, I think it could be pretty good for them. I'm not sure that it's going to deliver huge growth, but I think it's a good business and fits well within that more diversified kind of consumer goods portfolio. So yeah, definitely back them with that.
Right, should we move on to Hollywood Bowl in that case?
So Hollywood Bowl, we've covered it before. It's the major bowling alley, which is in the UK and also in Canada. So Hollywood Bowl had their full year results out with total revenue growing by 7.1% to £230.4 million. UK revenue growth came in at 3.8%, with like-for-like performance flat with varying trading conditions. Canadian revenue saw a 42.2% increase to 53 million Canadian dollars, which is about 30 million pounds, driven by new acquisitions and like-for-like growth of 6.3% at constant currency. Group adjusted EBITDA rose by 4.3% to £67.7 million, and adjusted profit before tax declined slightly by 5.2% to £45 million due to an impairment on the mini golf centres. And profit after tax fell by 12.4% to £29.9 million. Free cash flow decreased by 42.6% to £16.9 million due to increased capital investments. The dividend has increased by 2.1% to 12.06 pence per share, and the group highlighted that they've added 8 centres, including 4 in the UK and 4 in Canada, bringing the total to 85 centres. And in the UK, they opened new centres in Dundee, Westwood Cross in Kent, Colchester, and they acquired the Lincoln Bowl. And in Canada, they added in Waterloo, Ontario, which was a first built custom centre, and they acquired stakes in British Columbia too. Completed 12 refurbishments across both markets, and they've introduced new technology, including scalable booking systems, and expanded the use of pins on strings in the bowling centres. Sustainability, they commented that they added solar panels in 42% of the UK centres, which was going to, or in the future, going to increase their energy efficiency. And guiding going forward, they've said positive start to full year 25 with plans to open at least 6 more centres, 4 in the UK and 2 in Canada, with a target to reach 130 centres by 2035, remaining on track. In terms of valuation, the group have a market cap of around £580 million, and they currently trade at 16.5 times earnings, current dividend yield of 3.7%. I thought these results were reasonable. I think we've got used to having some pretty strong figures from Hollywood Bowl, particularly after COVID. I think valuation wise, for the numbers that they're delivering, it's okay. I'm a little bit worried about the business not being hugely diversified, and I appreciate that can potentially work, if you've got a strong trend behind bowling. Going on to mini golf, though, that's been doing less well as they've tried to diversify a little bit. So that's something that's a little bit of a worry. as is cost of living pressures, particularly seeing that in the UK, and labour costs with that most recent budget, particularly as you've got a lot of lower paid workers in the industry. I think that's going to, impact. So I think I'd be a little bit wary about Hollywood Bowl and probably wouldn't go, any further with it. But it does seem to be overall a well-run business in the industry that it's in, and it is the market leader in the UK and Canada. So there's certainly a lot to be said for that. Sam, what are your thoughts on the bowling industry and Hollywood Bowl?
Similar to last time, really. I just don't see. I think the problem is it seems like it's still very much a UK story. And I know it's dangerous to just use anecdotal, but I just can't imagine the demand for Hollywood Bowl is as high as it was when we were children. Because I just think children now have so many more options. I, I think it's good that they've got like-for-like growth of nearly 6% in Canada, because I would expect the UK to remain pretty flat in terms of like-for-like, although if they can open new centres, I guess that might help. But Canada, I guess they've only got 13 centres, so there is probably more opportunity. But I'd imagine there's already quite established bowling brands in Canada, so it's tricky. What I would have found most interesting was the mini golf centres, which I don't know, just seem a little bit less stagnant. But then they've impaired those, which suggests they're not actually doing that well either. I did think that what they should do is I think they should buy Junkyard Golf. I think that's what they should try and do. I think something like that, where it's kind of similar, but I don't know, it's just a bit more exciting. But if you look at the Junkyard Golf accounts, so I've got them up on Company's House, just in case anyone's listening from Hollywood Bowl. So a profit of 3 million on turnover of 18, and then let's see how much equity there is on, and then there's nearly 8 million of equity on the balance sheet. So I don't know, it's a sizable acquisition, but I think it's of a size where I think if they were to try and get it, there's a discussion to be had. But I think that would potentially inject a little bit more growth into it and add a bit. I know it doesn't need to be exciting to be a good performing investment, but I just think Junkyard Golf, you see them popping up everywhere. It would probably complement the brands they've already got. And I think if they were, even if it wasn't exactly Junkyard Dog, but if they were trying to go out and add something like that on or create something like that, I'd feel a lot more excited rather than bowling, which I just feel is incredibly saturated already and doesn't really have anything kind of unique about it. What do you think of Junkyard Golf as a potential
I haven't
acquisition?
actually, I've never been to a junkyard golf.
I've never been either, but it's probably not a great start. But
No.
I know people who have been, and I know that in the city centres they are quite popular. And
Okay.
we
And
could
what's the
go for
US?
some market research actually.
Yeah, what's the USP?
I think you just get drunk.
Okay.
Just one sec. Apparently, it's epic crazy golf, and you go in and it's like it's inside and it's like neon lights and stuff like that, and you have a few drinks and stuff like that, and it probably looks a bit better because you're smashed, and it's got like
Okay.
looks a bit like a paintball ground or something.
Fine.
It's much more like adult themed.
Okay. So it's a kind of a start, well, a start of a night out, really.
Basically, yeah. So you'd go there and have a few drinks. It's all kind of lit up like a club and stuff. And because of that, they are charging you a premium as well. But I've never been, but from the pictures on the website, it does look quite good actually. It
Yeah,
also looks quite expensive.
I was just gonna have a look.
I mean, it looks like the inside of Pop World or something, actually.
Yeah. And tickets, yeah, I see what you mean. It's
But like you
yeah.
say, I think it's the start of a night out, which I think
Yeah.
mini golf or bowling would rarely be. So it's
Yeah.
just a different sort of part of the market they could potentially capture. But I think it would sit quite nicely in there.
Yeah, from the looks of it, it probably would. Maybe that's where the growth comes from. They'll acquire it for
Maybe we should
Junkyard
send them a
golf.
letter and some kind of commission basis.
Well,
But anyway,
or
should we move
yeah,
on to our US company?
yeah, no, absolutely, Sam. So, Ashtead.
So Ashtead, it's a company we've covered before, although we have only ever covered it as a UK company. So, and at the moment, it is actually still UK listed, but we're claiming it as US, so, as will be revealed later. So, Ashtead, who are listed on the FTSE 100, they have come out with their half-year results, and they've reported revenue growth of 2% over the first half to 5.7 billion, and all these figures will be in dollars. Rental revenue rose 6%, driven by volume and price improvements. In the key North American market, mega projects and hurricane response efforts more than offset lower activity in local commercial construction markets. Underlying operating profit fell 1% to 1.5 billion as lower used equipment sales and higher costs more than offset the revenue growth. Net debt at 31 October 24 was 10.9 billion. And there was free cash flow of 420 million compared to a 355 million outflow last year. Full year guidance has been lowered, and they're now looking for rental revenue growth of 3 to 5% compared to 5 to 8 previously. Capital expenditure is also coming down, though that's expected to boost free cash flow, which is expected at around 1.4 billion, and that was previously at 1.2 billion. Ashtead plans to move its main listing to the US whilst maintaining a secondary listing in the UK. An interim dividend of 36 cents a share was announced, and the shares fell 7.7% in early trading. So this is actually the fourth downgrade in 5 quarters. And in terms of the moving the primary listing to the US, well, they view themselves as a US business. They're reporting US dollars. Almost all the operating profit comes from North America. So in 2024, 98% of the operating profit came from North America. Their operational headquarters and management team are in the US. They've not said it, but you do think maybe they'd benefit from a higher valuation in the US as well. I do have a list of other companies that have recently moved their primary listings to the US. So there's Flutter Entertainment, which owns Paddy Power. I think that makes sense, given a lot of the growth based on what we've seen from Entain does seem to be coming from the US now. So I think there's some logic to that, and it's very much a growth market over there, whereas it's much more saturated here. Arm Holdings, I don't think that was really that intentional, because it was going to be bought by Nvidia, and then that was rejected, and then they popped back up in the US instead of the UK. 2E, that's German anyway, so that's fine. And then Nvidia, which I don't really know anything about, but they said the US was a natural long-term listing venue because of the profit, the bosses, the headquarters, and the employees being mainly based over there. So I think the move kind of makes sense. I don't think it's really that much of a slap in the face to London. I think it's just as the business has evolved, it's made less and less sense to be listed in London, given how good the American capital markets are as well anyway. We'll possibly cover it still because it will continue to have a secondary listing on the FTSE. However, it will primarily be a London-based, US-based business. In terms of valuation, it trades at a forward P of 18.9, and that compares to a 10-year average of 15.2. It has a prospective dividend yield of 1.4%, and that compares to a 10-year average of 1.7. My view would be I don't actually think they're going to get much multiple expansion, because I think a forward P of nearly 19 is quite expensive. And when they keep giving profit downgrades, I think even in the US, you're going to be punished for that. I don't think that's a huge factor for them, and I do get the impression that the reasons they've given are genuine ones, and it does seem to make sense given that it is basically a US business anyway. But I wouldn't, if I was a shareholder holding this, I wouldn't be thinking there's going to be much multiple revaluation once it moves over, but we will see. I think it's quite expensive given the results it's putting up. The concern I've always had with it is how capital intensive it is, and I think that's kind of been shown. And it's as well, they're selling the used equipment, and they're not getting as much for that as maybe I don't know if as maybe as they were a few years ago, and that's offsetting the revenue growth. Because what happens is the fleet gets to a certain age and they get rid of it. I think the average age is about 4 or 5 years from one of the previous times we've covered it. But you have to keep replacing it, and that equipment is not cheap. And you've seen that with the capex and the free cash flow being all over the place. So it's just, for me, not an attractive industry, and I think it's quite expensive for what it is. What do you think, John?
Yeah, I mean, I think it's done well over the last 5 years. Bit concerning that things are slowing down and they've had a few profit warnings. Certainly, it's not cheap despite that. And yeah, I think, as you say, high in terms of capital expenditure, and there's nothing they can really do about that. So I don't think, the industry that it operates in is particularly attractive. But they seem to be well run overall, and making the best of it in that what is a difficult industry.
Do you think the moving of the listing?
I think it's fair enough. I think you can see why a lot of UK businesses would do it, and you'd hope for that sort of revaluation. And also the logical argument that most of the revenue has been from the US, North America anyway. So to be listed over there does make sense. I think the more disappointing ones, but equally logical, would be things like Arm, because Arm, whether it would be the UK's biggest company, I think it might be, if it was still listed in the UK, it would certainly be up there, because I think that's got a valuation of about $150 billion. So
I think it must be then in that case.
It must be, yeah, which is a great shame to have lost that. I appreciate it was, acquired, and then it was part of SoftBank, and then they sort of spun it out since after, I don't know if there's a competition issue with Nvidia that sort of blocked the acquisition, their acquisition of it. But it's doing well on its own. I think that's a bigger loss to the UK than Ashtead.
So, of the 6 businesses then that we've covered this week, Bunzl, Baltic Classifieds, Carnival, Supreme, Hollywood Bowl and Ashtead, which do you like the most and which do you like the least?
I think I like Baltic Classifieds the most. The difficult thing is the valuation with it. In terms of what I like the least, I would probably, well, in fact, that's quite easy. I'll go from Carnival. There are a few there that or a couple there at least that I'd be a bit wary of, but Carnival actually that's fairly clear.
So I think I also really like Baltic Classifieds, but the valuation is just uninvestable at the moment. It would probably have to get slashed by about 2/3, at least half anyway.
Yeah.
Supreme, very happy with that, very happy with the performance. I think there's some concerns about the transition away from vaping, although even that might not be too bad based on what they've been saying in terms of a lot of the disposables switching over to the actual proper vaping kits. I don't know what they call them, but so that might not even be too bad. But I think that's priced into the valuation at a PE of 8, and I think they're doing the right things and the best they can to try and mitigate that anyway. In terms of least favourite, also Carnival is quite an easy one. I think the debt and the industry combined still make it uninvestable, although the debt is a lot better than it was.
Yeah. Fair enough. Well, thank you very much for listening, and we will be doing our Christmas special with the fancy portfolio shortly.
Yes, right. We'll see you all next week for the fancy portfolio update.
See you then.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.